Hey, what's up guys? John here. Rents are falling in a lot of hot markets, and I believe that this is going to be the beginning of problems for a lot of landlords. Last couple of years, we've seen so much activity across multifamily real estate. We've seen so much money being borrowed and leveraged into assets to curb against inflation and to multiply wealth. But I think that show is coming to an end, and I think we're going to see some really big changes. It would not surprise me to see rents go back to what they were 4 years ago or 5 years ago. A lot of people say there's no way that is possible, given a couple of circumstances. One, mortgage rates are rising, and rates rising means a lot of buyers are going to get priced out of the market to buy properties. They're going to be forced to rent. There's going to be upward pressure on rents. Second is going to be there's a lot of deep pocket investors, Pretium Partners, Blackstone, a lot of these big companies that purchase 100,000 homes, 100,000 single family homes. They own so much inventory, there's no way they're going to decrease rents. Here's what I think is going to happen, and here's why I think they're going to potentially decrease rents. But regardless, even if they do not, I still think we're going to see rents fall in a big way. Take a look at this. So let's say, for example, you are a multifamily real estate investor and you purchased $2.5 million value add property. So what is a value add property? It means you're going to buy it and you're going to add value. How can you add value? It's either going to be decreasing the amount of expenses on the asset or increasing the income on the building. And the more income that the building produces, the more the building is going to be worth. And so what were people doing? They're going into all new markets, buying properties in which they could take a 3.5% interest rate, to combat inflation, and take this interest rate to buy a really good asset, to add value, and to refinance their money out of the property, to hold the asset, to grow wealth, or sell the property for a profit. That was the ideal situation, right? So how would this look? And now what do I think is going to happen with these landlords? So 2.5%, $2.5 million deal, 10-unit value add property, down payment $750K, 30% down, cash invested to fix up each unit, 20 grand a unit, right? So they're all in $200,000 in the value add process plus the $750K down payment. They're in 950 grand. It's a substantial investment. And the loan amount is $1,750,000. $1,750,000 loan amount based on a 3.5% interest rate. They are in monthly cost $10,276 per month. This does not factor in management, maintenance, building emergency reserves, evictions, repairs, none of that, right? And so call it a flat 14 grand. 14 grand. And they're in with gross income, right, on purchase, $1,500 a unit. So they're in for, maybe they're making $1,000 a month. They're $1,000 a month. They're making very little, almost nothing. But after all of the work being done, everything is done, maybe they'll make 5 grand a month, which isn't bad, right? But $1 million on 5 grand a month is 5% return on cash. With all that work being put in, a lot of people would say that's not a good deal, right? But when interest rates are very low, it makes sense to do it, right? And so this is the curveball that all investors are getting hit with right now. A lot of these people bought these properties with 3-year, 5-year, 7-year arms, meaning that they're going to have to try to refinance these properties down the road, or they're going to be hit with these increased rates. And now what's going to happen is we're seeing interest rates rise, we're seeing rents starting to fall, vacancies are rising, insurance costs are rising, property taxes are rising. It's a problem for landlords. A lot of people say there's no way rents are going to fall. Well, right now, slamming on the brakes, South Florida's record rent hikes are slowing down. New York Post, huge rent hikes may finally be coming to an end. Well, rents are rising everywhere. This is April 21st. Rents are rising everywhere. In the just last year, rents rose on average 11.3%. Last 2 years, about 20% rents have risen. And so here's how I think that this whole thing can play out now for all these landlords that are extremely leveraged. So if today's interest rates are 6%, they bought this property, $2.5 million purchase, they put $750,000 down, their total monthly cost $12,910. And if rents go back from their former highs, the acquisition price would be $15,000 in gross monthly income. Now, a lot of people say, John, that's pure speculation that rents are going to go back from this purchase of $1,900 per month to $1,500 per month. How can that happen? You're just pulling that out of thin air. This is what is happening right now. Home builders say U.S. is in a housing recession as sentiment turns negative. Bloomberg, U.S. home builder confidence hits worst slump since 2007. The Hill, home builder confidence dips 8th straight month. But now we're seeing the most housing units under construction since 1974. And we look at Fred's. In 2006, the all-time high of home builders, new privately owned housing units under construction, 1,423,000 units. We look at where we are right now, 1,678,000 units. We're going to see a lot of inventory hit the market. We're going to see so much inventory hit the market. And what are these builders going to have to do? They have two options. One is they're going to sell these properties. But how can they sell these properties if interest rates are rising and it's more expensive to borrow money and buyers are pulling back, right? They're not going to likely be able to. So a lot of them are either going to have to turn to rentals or they're going to have to sell entire communities. And what I think is likely going to happen is I think that they're going to try to rent out these properties, and if they can't, they're going to have to sell them, right? And so we have all of this new inventory that's going to be hitting the market very, very soon, and I think it would make sense for deep-pocketed Wall Street investors to start decreasing rents. And why would I say that? Why would deep-pocketed investors decrease rents? Well, it would do a couple really, really good things for them if their goal is to expand market share, which is their goal. Why? How would this play out? This is what would likely happen. If they decrease rents by, say, 10% or 15%, this would then, in theory, push all of these home builders to decrease their rents. And if they have high cost due to supply chain bottlenecks, increased labor cost, and longer holding periods on these communities, it's going to mean that they are going to be pushed into financial distress, which could afford a bigger opportunity for Wall Street investors. This could also push a lot of mom and pop landlords that are extremely leveraged because over the last couple of years, a lot of people took out refinances. They borrowed money against their assets based on increased rental income. They borrowed this money and they bought either other properties, they invested into their business, or they went on vacation and just spent money. A lot of people are extremely leveraged. And so that the more pressure that Wall Street can lay onto other landlords, the more authority that they can instill inside of this marketplace. Now, I also believe these rising rates are likely not going to be the end. I think we're going to see rising rates continue to get worse and worse and worse. And so this situation here, back to this deal, $2.5 million deal. If rents are going back to the former high, right, because there's a much more inventory coming to the market, what is likely going to happen? It's going to mean that their carrying costs are going to get much, much more expensive. And so if rents go back to $1,500 per month and 2 of the 10 units are vacant for 60 days, that's not a big deal. You know, if you have out of 10 apartments, 2 people move out. They move out 1 month and then you find a tenant that month, they move in the following month. So you have 4 months of total vacancies out of 10 total units per year. That's not that bad. Say that they do. And they have 1 eviction that costs them $5,000, which is very inexpensive, especially at a place like Los Angeles or New York where an eviction could cost $20,000. And they have $10,000 in repairs. Maybe they have to, do the roof. They have work that they have to put into the property. How would this all play out? Well, their new carrying cost of $12,910 at 6% interest rate, 5-year ARM, plus $6,000 in vacancy costs at $1,500 a unit times 4 months, right? $5,000 eviction, $10,000 repairs. Their monthly cost would be $14,660, right? And this does not impact any or have anything to do with any rising insurance costs or rising property taxes. This is just disregarding all of that, and it doesn't include any type of property management, meaning their all-in cost would be $14,660, and their gross income would be $15,000 if they were rented full time, right? And so you can see that these landlords are going to start to really become leveraged. But what I think is very likely to happen here is I believe we're going to start to see more of this. Landlords try to stop rent control initiative in Florida. And this. Chicago or Kingston becomes first upstate city to adopt rent control. Chicago, rent is spiking, so tenants are forcing unions and pushing for rent control to stay into their neighborhoods. I believe that's what we're going to start to see. I think we're going to see a lot of tenants saying, you know what, I need protections. And they're going to push for more government protections. More rent control is going to start to come. I think we're going to start to see a lot of pain, a lot of challenges coming for landlords all across America. And this is not a bad, this isn't bad for a new investor that wants to run out there and buy in the future, because the more information that comes out, the more risk that you can see, the better you can underwrite a deal, and the more confidence you can put into an investment. Over the last couple of years, people just thought they were untouchable. And they were going out there just buying all over South Florida, buying all the hot markets, buying in Austin, just thinking, hey, this is never going to end. This, I think, is coming to an end. I think we're going to see a lot of pain come, and I think that it's going to get really, really challenging for a lot of these landlords to hold on to these properties, these leveraged properties. But I think if you're a landlord, you have low debt service, you can pivot, you can move with the times, you're going to be okay. But I think if you're a landlord that has very, very, very slim margins or extremely leveraged, I think that this could be an opportunity in which Wall Street is going to be able to tip you over. And that's what I think a lot of Wall Street investors are going to be looking for, is ways in which they can capitalize on pain, because that's what they do. They capitalize on pain. The more pain there is in the economy, the more money and more authority they make, and more authority they control. And so that's what I think is going to happen. What do you think is going to happen? I think over the next 2 years, though, next 6 months, a year, 2 years, we're going to really start to see everything shift into a very, very aggressive buyer's market. And I think there's going to be massive opportunities for smart and savvy investors to run out there and capitalize. What do you think? Drop below, hit the like button, subscribe here, and on my second channel. If you want to invest in real estate, but you don't know how or what to buy or where to buy, how to invest, visit cashnow.video. If you need help fixing your credit score so you can get the best mortgage, visit cashnow.video. And if you want to get on the YouTube grind with me, cashnow.video. Catch you guys in the next one. If you're interested in being sponsored on my YouTube channel, visit cashnow.video/sponsor and fill out the application.